Good afternoon, everyone, and welcome to the 2 o'clock slot, where we're joined by Ian Hargreaves, who's manager of Invesco Asia. In our view, IAT, which is Invesco Asia's ticker, could serve as an excellent core Asia exposure. Ian has a good track record of adding value through stock picking in both growth and value sectors, and the portfolio is balanced across the region on a geographic and sector basis. At this point, given that in our view neither growth nor value look like they'll have the upper hand going forward, with returns coming from both at different times, this looks like an attractive way to be positioned. Ian has shown himself to be astute in managing gearing too, and for income investors, the trust offers a solid yield. And for these reasons, we think there's no good reason for the discount to be so wide relative to its peers. We note too that the discount has been significantly narrower than it is today in recent months. I'll now hand you over to Ian so he can tell you more about how the fund works.
Thanks very much, Pascal. Good afternoon, everyone, and thanks for your time today. So what I'm aiming to do in the next half hour is spend a bit of time explaining how the trust is managed, and then leave time to talk about our outlook on the region and how the trust is positioned at the moment. As a team, we believe that the most sustainable way to make money is to invest in companies that are worth more than the market believes. And this places valuation really at the heart of what we're doing and at the heart of our investment process. And experience has taught us that some of the best ideas that can be found by looking in unloved areas of the market, and so we take a relatively contrarian approach to uncovering new ideas. We also integrate ESG as part of our approach, and it's integrated into our valuation-led methodology. This chart gives you a stylized view of the life cycle of a company and the relationship through time between a company's fair value and its share price. And I guess the key thing to point out here is that the fair value of a company tends to be much more stable through time than the share price, and you see a lot more volatility of share prices. The reasons for that volatility can be varied. They can be to do with company specifics, or they could be to do with a change in the macro environment. But ultimately, it's that volatility that we believe provides us with investment opportunities, and it's the tendency of the market to take current events today and extrapolate those and reflect those in the valuation of the long-term valuation of a company. So in order to be successful in using this approach, I think you certainly have to have the willingness to be contrarian. You need to have very strong fundamental and analytical skills in order to attempt to pinpoint company valuations. And I think you also need patience and a longer-term horizon in order for the undervaluation to be corrected. I think the other important thing to say is that we're pretty agnostic about the kinds of companies that we'll look at, and we think that this approach can capture both growth style companies and traditionally more value type businesses. And the thing that ties them together is perhaps a temporary undervaluation of the company. And I think our investment in MediaTek, and here you can see that we've got the share price of MediaTek, but also the shareholding in the investment trust in the light blue as well on the chart. I think the investment in MediaTek is a pretty good example of the process in practice. So MediaTek is a designer of silicon chips in Taiwan. Those primarily go into consumer electronics. And I think if you ask most market participants today, they would say that MediaTek is one of the leading growth companies in Taiwan by virtue of its success in 5G. But you can see from the share price chart that 4 years ago, it wasn't perceived very highly by the market. And in fact, I think that 70% of analysts had a sell on the stock at that time. And the problem for MediaTek was that they had a problem with their smartphone business back at that point, and that business represents almost a half of their revenue. And the problem for MediaTek was that their 4G product was inferior to their main competitor, Qualcomm, and that meant that they were forced to sell at a discount, but also their cost of manufacturing was high. So they got squeezed. Their margins got squeezed from both angles, higher cost as well as lower price. And what got us interested in this company, firstly, was the fact that the share price had already declined substantially. But at that point, at the beginning of 2017, almost half the market value of the company was backed by just the cash and the value of their non-core investments on the balance sheet. So that encouraged us to take a look at the business, which resulted in a number of meetings with the company where we learned that they had new products that were slated to be launched actually 12 months later at the beginning of 2018, and that those would hope to address some of the flaws of their existing products. So I suppose our investment case was that at that point in early 17, the market had the stock trading on a pretty low valuation based on earnings that were low by historical standards. So their margins were almost half the level or less than half the level than they typically achieved over the long run. And so we felt that actually, if these products were successful, you would see some margin recovery, and earnings would end up being considerably better than the market was forecasting. And I suppose that was the risk in the investment, but we were significantly encouraged by the fact that our downside was protected by the cash that they had on the balance sheet. And so our experience of knowing MediaTek over the long run and actually their ability to transition through tech cycles historically from originally making chips that go into DVD players, gradually through 2G phones into 3G and 4G, was also an encouraging factor in believing that they could turn themselves around. And you can see that is in fact what happened. I also wanted to just briefly touch on how the ESG fits into the picture. And I think this chart summarizes it quite well. So our process, as I've explained, is all about trying to establish a company's fair value and trying to buy at a significant discount to that. And we think that it's really critical to consider the important ESG issues for each of the companies, because really a failure to do that could result in us simply getting the valuation wrong. And I think as time has gone by, this has got more and more important. I would also say that ESG consideration can be part of the investment case as well. So I can think of a number of occasions where we felt that the market has been too negative about a company either from a governance standpoint. They might have been concerned about their capital allocation. And so there are occasions where we think actually the company can either improve or is not as bad as the market thinks. And so that's an opportunity to invest. And finally, there's the part after we make the investment, which is the engagement that we do with companies in trying to nudge them in the right direction. So we're in essence trying to increase the fair value of the company by encouraging our companies to do the right kind of things from an ESG point of view. The other thing that I think is important to mention, particularly when when you're investing typically a bit against the grain is that the one thing that can trip you up is balance sheet stress. And I emphasize the fact that we need to be able to take a longer term view and have patience. But there are situations where a company could run out of time if their balance sheet is under stress. And so this is something that we really emphasize in our process. And you can see in the slide that we have a significant portion of the portfolio that is invested in net cash companies, but also in companies that have relatively low debt to equity, and within our financials portfolio, typically better capitalized than the market average. Next, I just wanted to highlight some of the changes that have been happening in terms of the company itself, and I think the board has been making significant strides to try and enhance the corporate proposition within Invesco Asia, and this has really resulted in two things last year. Firstly, to put in place an enhanced dividend with the aim of paying 4% per annum in 2 installments. But also they put in place a performance conditional tender, which looks at the performance of the trust over 5 years and whether it's out or underperformed. And the aim here is really to try and to control the discount that the company trades at. And then I also wanted to mention the way that we think about gearing. I think this approach to gearing is dynamic, and the aim is to enhance returns over time. But we've been really keen for it to fit within our existing investment framework. So the way that we control gearing is really to flex it up and down depending on market valuation at a given point in time. And you can see, for example, back in late 19, early 2020, when valuations were low, the trust had relatively high gearing, and now markets have recovered and valuations are above average. We're holding net cash within the portfolio. And then I suppose this is a slide on performance, which I suppose is the reflection of whether the process has worked over time. And you can see that the NAV of the trust has compounded at a little over 11% over 10 years, and that's a bit over 200 basis points better than the index on a compounded basis, net of costs, of course. Now, turning to the outlook for markets, I put this slide in as just I suppose a reminder of how well Asian markets have done in absolute terms, despite the pandemic. And I think there are a number of reasons for that. I think Asia has been less impacted economically than some other regions. I think particularly North Asia actually handled COVID quite well, and so the recovery process started earlier than we've seen in the West. And I think the other important thing is that Asia has had a high proportion of companies in the market that actually proved to be beneficiaries of COVID. And here I'm really thinking about the technology sector, tech hardware, semiconductors, but also internet companies as well that saw their market penetration go up as a result of COVID-19. I think the other important thing to say is that the earnings certainly ended up being much less impacted than we might have feared back in the first quarter of last year. And here I focus on the red line on the chart, and you can see that earnings are actually, in the end, the 2021 earnings are only about 5% lower today than they were forecast to be before the pandemic started. So I think it was a much milder impact than expected. But the reality is that, you know, with markets substantially up from pre-pandemic levels and earnings still down, the natural result of that is that valuations are, you know, have got re-rated, and you know, by the first quarter of this year, we were starting to get a bit concerned about valuation, which is reflected in the change in gearing in the trust. One of the ways that we try and look at valuation from a longer term perspective is just to look at forward-looking returns from different valuation levels, and you can see that, you know, at price to book, where we currently are today at about 1.9 times, historically at least, forward-looking returns start to come down, and this makes us believe really that at the very least, Asian markets need to go through some kind of time correction, and to allow earnings to catch up and for book value growth to catch up. And I think it's realistic to expect that, you know, that this earnings cycle isn't over yet. Here I'm showing the chart of the global PMI, but I think when you look at the situation across Asia, but also globally, there are still significant parts of economies that are yet to fully recover. And I think an important point of difference between today and the global financial crisis is that the financial sector has emerged in much better health than was the case back then. And so we are unlikely to see the additional pressure of the need for banks to deleverage, which proved to be a significant damper on growth over the years that followed the GFC. I think also that both the corporate and the consumer sector in Asia, and frankly globally, has emerged from the crisis in pretty good shape from a balance sheet point of view. And you know, we're still relatively early in the cycle. Certainly, we're starting to see discussions about the need to tighten, for example, in the US. But actually, there has been limited tightening action outside of China. And so I think it's premature to start to get too worried about the earnings cycle. So the way that we're thinking about it is that, you know, as this PMI chart suggests, we're through the best of the rapid acceleration of demand, and that acceleration has really helped Asia because of its export sensitivity. And as we look ahead, we're likely to see a more gradual earnings recovery than what we saw over the, I suppose, the 12 months ended March 21. But earnings should still continue to progress upwards. And one of the ways that we're starting to see that being reflected is through a greater variation of performance at the sector level. So this chart just shows sector by sector earnings revisions, the number of revisions divided by the number of downgrades. And if you looked at this chart 6 months ago, I think all but 2 sectors were in net upgrade territory. And since that time, you're starting to see some divergence taking place. And I think that's a natural result, in particular, of early signs that some of the companies that were really beneficiaries of COVID, having built up expectations in the market that were hard to achieve, and some mean reversion of those businesses. And the flip side of that is sectors that were late to recover, for example, like banks or financials, that are seeing positive earnings revisions now. And I think that's particularly important because while we worry a bit about, or have worried a bit about overall market valuation, when you look a bit deeper into the market, at the sectoral valuations, actually we can see quite a huge divergence. And here the way to read the chart is the blue bars are the 10-year averages, the dots are where the market is valuing that sector today. And so we're ranking biggest premium on the left-hand side to lowest premium on the right. And I think what's interesting for us is that some of the sectors that we are more concerned about a risk of negative or excessive earnings optimism and a risk of disappointment over the next 12 to 18 months also happen to be some of the sectors that are trading at quite big premiums to where they've traded historically. So what we've been trying to do in our portfolio is effectively reduce our exposure to sectors on the left-hand side of the page here, where we have concerns about sustainability of those earnings, and look for ideas more on the right-hand side in sectors where valuations are not particularly high by historical standards. And you can see on this chart what that's resulted in. And here I'd focus particularly on the right-hand side here. In the purple boxes, you can see the change in active weight within the portfolio so far this calendar year. And the big thing to point out really has been the reduction in IT, and here we're really talking about semiconductors and tech hardware. So this has gone from being one of the big overweight sectors within our portfolio to being now being underweight. We still think that there are some strong secular themes within technology, but we also think that that some of the tightness of capacity that we're seeing today will get resolved over the next 12 to 18 months, which will lead to some deterioration in earnings growth and returns, and we don't think prices of some stocks reflect that. On the flip side, you can see the other important change has been the reverse from a geared portfolio to one where we have net cash, and we currently have about 3% net cash within the portfolio. The other important additions to the portfolio have been real estate, and you may have seen on the previous slide, real estate remains one of the sectors with negative earnings revisions, and it has been the most impacted by the pandemic for a variety of reasons. But we do think that there are some interesting opportunities there right now. We've also increased our exposure to financials, primarily through some holdings in China more recently, but also in Southeast Asia. And then finally, over the course of the recent sell-off in internet, we've added to some of our holdings within the e-commerce sector, which has led to some increase in consumer discretionary. And you see a very similar pattern when you look at the market from a country by country basis. You can see that Taiwan and Korea are quite significantly.
Can I interrupt you for a second there, Ian?
Yes.
I'm afraid we lost you for about 20 seconds there. You wouldn't mind
really?
just back up to the last slide, would you?
Oh, sorry. Sure.
And maybe turn your video off as well, a bandwidth issue?
Possibly.
Thanks.
What was the last thing you heard me say?
I think it was the start of this slide.
Okay, I apologize.
Sorry, no worries.
Yeah, so I I was saying that the most important change to the portfolio has been the reduction in the technology weighting, and that reflects the fact that we worry that some expectations in the technology sector will be hard to meet, given the likely addition of capacity and the fact that that valuations are much above historical averages, and that money has been partly used to reduce gearing, but also to increase exposure to financials and industrials, real estate, which are all sectors that are cheap by historical standards. And in the more recent sell-off to do with the internet in China, in August, we've also added to two of our holdings in the e-commerce sector, which has led to an increase in consumer discretionary. The next thing I wanted to say is just the same divergences that we see at the sector level are also quite apparent at the country level as well. Korea and Taiwan is very much tied up with what's been going on in the technology sector, but you can see also India now is trading at a big premium on an absolute basis to the region, but also to its own history. So, much that we like the structural story for India, and it's been a big overweight market for us over the years, we're increasingly struggling to to justify the overweight position that we have. Conversely, you can see at the right-hand side, Southeast Asia, some of those markets in Southeast Asia are quite cheap within their own historical range. And I suppose the big change over the last few months has, of course, been China, which has been the worst performing market. So China, I think, at the end of the Q1 would have been one of the markets over to the left, or already the valuation rating has started to look more reasonable. And really, we've seen pretty significant changes to the makeup of our geographical makeup of our portfolio because of this. So you can see Korea and Taiwan, quite big reductions in our holdings, which reflects the technology angle, but also nearly 4% out of India as a result of some of the companies that we own reaching our estimates of fair value, and the increases have really been driven by buying two new holdings in Indonesia, but also more recently starting to reduce the quite large underweight that we had in Hong Kong, China. And that's really what I'd like to spend the last few minutes of the presentation on, because I think it's quite topical. So this chart is one of the reasons that we had previously been a bit cautious about China and had actually been reducing our holdings there last year, partly a reflection of valuation, but also the fact that the government has been pretty quick to begin to tighten policy after a brief period of stimulus during the height of the pandemic, and I think this reflects a real change in the way that the Chinese government wants to run the economy. They don't want growth at all costs. They're much more focused on quality of growth, and they're very focused on the risk of having too much debt in the economy. And this tightening of policy is to address that. And I think they've used this period of strong global growth and an excellent performance from the Chinese export sector to address some concerns over leverage. And so we were concerned that this would, given where valuations were, this might have an impact on earnings. And we've definitely seen, for example, consumption after the initial bounce back from COVID has really been quite flat, and so the consumer sentiment is a bit soggy in China right now. But I think given now that the market has fallen considerably, we're increasingly interested in China as an opportunity, despite all of the negative headlines. And I think what makes it interesting is if you juxtapose, where China is in its cycle, where it seems to be quite far ahead in terms of returning to some kind of policy normality. Those issues still lie ahead for a lot of developed markets in particular. And so as we go ahead, places like the US will need to be, investors in their markets will need to be concerned about what will happen to economic activity when policy, returns to normal. And the fact of the matter is that China has already tightened, has already normalized policy. So I'm starting to think of China as actually a more or a less risky place as we look ahead, particularly when you look at relative valuations. And actually, we're much closer to the point that policy starts to ease in China than the likelihood of further tightening. And just to talk about a little bit about the Evergrande issue, which I think is important. I think the Evergrande problems are really a symptom of the fact that the government has been tightening against the property sector now, not just for 1 year, but actually for 5 years. And I think that's shown very nicely on the right-hand side, which just shows the amount of new mortgages relative to residential sales, and that peaked in 2016. And what's one of the reasons that property sales are so weak at the moment is that it's so hard to get a mortgage, and new mortgage issuance is really running at only something like 20% of new sales. So you're having to wait to get a mortgage, but also the required equity is very high. And so I think there's ample scope for them to relax and improve demand. And I would use these charts to argue quite strongly against the idea that the property market is in a bubble in China. The typical symptoms of a bubble are excessive leverage on the buyer side, and prices that are very high relative to incomes. And I don't think China ticks either of those boxes. Even if you look at the sort of cumulative mortgage on the right-hand side, it's cumulatively only about 30% of property sales, which implies that the loan-to-value ratios on a mark-to-market basis are, a sub 30%. Which is pretty low by global standards. And on the left-hand side, you can see the trend of property prices relative to incomes. So there are a lot of headlines about, and it's true that in some of the bigger cities, prices are high, but if you look at them on a national basis, prices haven't really been increasing much relative to people's incomes. So I think that's an important and a very important consideration, and is one reason why we've been using this weakness actually to make an investment in a property company that we think is well placed to gain market share as other developers are forced to deleverage. And I think I'd just like to maybe just make one comment on the internet sector as well. I think I'm over time, but I think it's also important. I think we've seen a lot of regulatory activity, particularly related to the internet sector over the last few months. But I think context of where share prices started is quite important. We were quite concerned a few months ago that valuations in the internet sector were too high, and we were reducing our exposure as a result of that. So some part of this correction is associated with that earlier, full valuation. And I think what we're seeing from the government here is a correction of some of the flaunting of the existing rules that internet companies were doing. I think, particularly in the antitrust area, internet companies were not doing what is expected of companies who operate in the offline world, and so it was natural eventually that this was going to get corrected. I think also COVID-19 highlighted to the government just how reliant the economy has become on the internet sector for a variety of things: shopping, entertainment, payment, to some degree credit as well. And so I think there is a desire for more control and to fill in the gaps of regulation. But we are a little bit doubtful that the government wants to destroy this sector. And so by the time we got to August, when valuations for some of the companies that we really like from a long-term point of view had reached the lowest levels that we've seen for 10 years, we actually saw that as an opportunity to buy. And we've made pretty limited changes to our earnings assumptions based on the rule changes that we've seen for most of the companies that we're invested in. I think I'll pause there, as I'm over time. Happy to take any questions.
Got some questions here for you, Ian. And apparently you can turn your video back on. I think it was my end rather than yours that was going wrong, so I'm sorry about interrupting you.
That's okay.
So just to sort of start with a fairly general question, can you tell us about your research team and where they're based and how they operate and how you get your ideas, for the portfolio?
Yeah. Well, we've got a team of 9 people, and we're all based out of the Henley office in the UK. And we source ideas from a number of avenues. It might be use of simple quant models that highlight potential undervaluation, which fits with our investment process. Frankly, we trawl through the market looking at companies that have maybe not performed well over the short term, and just trying to come up with potential ideas to do further work on. We meet a lot of companies. In a normal environment, we'd be traveling to the region. That's been hasn't been possible recently, but actually in some ways it's improved our access to company management, because it's so easy to get people online these days. So we like the fact that we're a little bit removed from the market, based in Henley, and I think it enables us to aids our attempts to think in a long-term fashion, and I don't think it is any disadvantage from an access to information point of view. In a way, information is the commodity that's most in oversupply these days.
Thank you. There's some questions about China, and I'll put them all together. So, is the current argy-bargy about China and its place in the political world globally an opportunity in your view, or a threat for long term? Are you seeing value emerge as a result of it, or is it are you worried about it?
Well, I think I partially addressed that already. So yes, I do think it's an opportunity. I think we have to admit that over the last few months there were some events, for example, like the control on the private tutoring market, that were effectively took away huge chunks of the earnings of those businesses, was a bit of a shock, and I suppose demonstrated what can happen if your business stands in the way of the direction of government policy. So I don't think we should be too complacent about it. And as a result, I think it may take some time for valuations to recover. But in the long run, I think the government needs the private sector, and it needs the internet sector as one of the more vibrant areas of the economy in order to achieve its growth targets. And I think it will be hard for them to achieve a rebalancing of the economy without also having positive economic growth. And so the government is, I think, treading a very fine line between wanting to use this window to sort of overhaul regulation, but not doing too much damage to the economy in the process. And so where valuations are really low, and there's been collateral damage across the market, not just in the most affected sectors. This is an opportunity. I mean, one company that I would, or one sector that I would highlight is in renewables, a wind turbine manufacturer that trades on half the valuation of the equivalent companies in Europe. And it's one example where valuations are low in the China area. And part of that is a risk premium associated with what's been going on recently. And so that is an opportunity, we think.
There's a question related to that about the sell-off in Asia more broadly in February this year. Are markets, in your view, as a result of that, cheap in sort of objective terms? And are you looking at increasing the gearing with that in mind?
I'm definitely, I mean, events have been moving quite quickly over the last few weeks, and increasing the gearing is on my mind. But we're at the point where I think market valuations are still a little bit above long-term averages. It's within the market that we see opportunity, particularly increasingly in China and to some degree in Southeast Asia as well. So we will be using some of the cash that we have to invest in stocks that we're currently doing work on as a result of what's been going on in the market.
With carrying on from the same thing, have the kind of power cuts that have been taking place and the supply chain issues more broadly in the world, but with China at the kind of heart of that, have they had any effect on that trajectory, or is there any implications for those?
Yeah, I think I mean that is the sort of the latest of a long list of things that seem to be going wrong in China at the moment. And I think if there is one thing that I worry about in the really long term in China is this, the risk of an over concentration of power at the center and sort of top down decision making, and then officials at the local level being, I suppose, incentivized to carry those out to the letter of the law. And that's really what we're seeing at the moment with the power shortages. There are certain provinces that haven't hit their power intensity reduction targets for the year, and so they've decided to try and do that in the last quarter of the year. Economies don't really work that way, and so there are risks now that supply chains get a bit disrupted by this. But my guess is that the policymakers in China are, I think, a bit more pragmatic than the market is currently giving them credit for. And so I think we may see some changes in the near future to address this problem.
Great. And there's an interesting question on kind of stock specific stuff. But breaking up conglomerates generally seems to add value. Why isn't the breakup of Alibaba having the same effect? And do you think it will? Is there kind of value to come from there?
Yeah, I'm not sure that Alibaba is necessarily breaking up. And I think, it is the way that we look at that company. In fact, we look at many of the internet companies on a sum of the parts basis, because in most cases they have businesses that have a value but are not generating any earnings today. I think that in periods of negativity, there's a tendency to overlook that value and to focus on it more in periods of positivity. So I see it as a source of opportunity. I think it's unlikely that Alibaba will necessarily be broken up into its component parts, but we may see, for example, the cloud business may get listed at some stage separately.
Quite an interesting one here. Do the events in Hong Kong mean that Singapore has the potential to become more interesting as a potential destination for your portfolio?
Yeah, I think that's that is something that is it's a valid question. I think that some multinational businesses may look to relocate over the long run, either across the border into China, because there's limited difference between the two regimes. So the reason to have an office in Hong Kong perhaps diminishes over time, and Singapore may be a beneficiary of that. We have really only at the moment one investment in Singapore through our holding in United Overseas Bank, which I think is an attractively valued bank given the very decent level of profitability, and is likely to be a beneficiary at some stage if the global interest rate cycle firms up.
We haven't really got time for any more questions, although there are more in the bank. So we will send these over to you after the show. But thank you very much for joining us. Our next speaker is in 15 minutes at 3 o'clock, ICG Enterprise. So thank you all in the audience for joining us as well. And please do tune in again. Thanks very much, Ian.
You're welcome.
See you later. Take care.
Thanks, everyone. Bye.